Good morning, good afternoon, or good evening, depending where you are on the planet. And welcome to the Thursday, the 16th of May, Bull versus Bear webinar. Steve Miley here on the Call for Trade Day. Welcome, everyone. We're going to go through our regular run through in here today. We'll take a look at what we've had, what we've got coming up, take a look at the fundamental data, the macroeconomic data, the fundamental events, the geopolitical events that are central bank events that are shaping financial markets right here now, with a focus more on the markets that you guys are watching and trading. So let's kick off with, I'll just quickly look back and then we'll look forward. But it's kind of old news now, but effectively CPI data better than expected. The month-on-month number, better by a tenth. A lot of the other data pretty much in line with anticipations in here. But the month-on-month data in line with anticipations, we said yesterday, slightly better or even in line, will probably be bullish for the markets. That there was fear, obviously, after the last piece of data that we had, that things could look worse again, and for potential uptick from expectations. Well, we actually got on one of the measures a downtick from the month on month from 0.4 to 0.3 on the headline number. So that was seen as a positive. Most of the other data coming in bang in line with expectations in here. So limited impact. Retail sales in here actually slightly worse than expected, but not a bad thing in here. That's probably, even though that's showing a slowing of the economy, then with retail sales lower than expected, that's actually bullish for stocks. Why is it bullish for stocks? Because it's more likely that the Fed are going to, if retail sales are slowing more than expected, the Fed are more likely then to be increasing interest rates. So even though this number kind of shows a slight negative for the economy, it means potentially quicker stimulus from the Fed, and that's seen as a positive. So overall, obviously, this was taken as a positive. Equity indices spiked higher initially, as we kind of sort of thought they would. We did say we would look to buy the dips. Once then we got over the data, an hour later the cash market opens, and we did get a dip and an opportunity to buy, and then it was see you later after that, and it was only straight up into the close and nudging higher, further higher, held onto those gains after overnight, haven't given up those gains. Record highs on the major stock indices in the US, record high closes and record intraday highs on the futures in here. Going to today, we do get jobless claims. That's a weekly piece of data. Yes, it's got 3 bulls. Is it worth 3 bulls? I've been doing this for over 30 years. It's a weekly piece of data. It rarely has any influence on the financial markets. So very muted from jobless claims. So not looking to anything from there. And the rest of the data that we get in just under the hour, not particularly significant. We do get the Philly Fed. If anything, I would look at the Philly Fed manufacturing index is the most important piece of data we get there. Then at 9:15 Eastern, we get both industrial and manufacturing production. That could be interesting. I think really the Fed speakers are going to be more interesting. We have a host of those today. We get Barr speaking at 10, Harker speaking at 10:30, Mester speaking at 11:30, Bostic speaking at 15:50 this afternoon. So a host of Fed speakers watching out to their reactions to the CPI data. Is it moving the right way? Is it more likely that the Fed are going to move almost certainly not in the summer, but maybe into the early fall? And then do we get maybe 2 rate hikes? Do we get now maybe 3 rate, not hikes, forget hikes, 2 or maybe even 3 rate cuts? Just a quick nod to earnings, and then we're going to abandon that again until I think it's actually next week. Actually, I'll have a look in a second, but I think next week we get Nvidia. That's going to be the other big one to be watching. Oh no, there it is. There we got it on the so Nvidia next Wednesday, Nvidia. Okay, but today we've already had out Walmart, retail giant, obviously in here, and Walmart beating on both revenue and earnings per share. So adding another positive to the underlying theme of positivity that we saw coming through from yesterday's CPI data for the stock indices. Next thing on the agenda, really, and then we will be parking the earnings, will be Nvidia, the last of the Magnificent 7 stocks, as they are now called, to be reporting next Wednesday. That's after the bell, though, so Wednesday in the evening. Just a quick nod to the European briefing that we had already out in here from a live school, Goolsby, praising disinflation. Data obviously helping, a helping hand and a relief for the Fed in here. Morgan Stanley says watch for a Fed September rate cut. So that's fairly dovish in here. So it's kind of a bold statement here, looking for a September rate cut. So that does open the door to potentially 3 rate cuts going into the end of the year. 5 things to start your day in here. Inflation ripples. US stock prices are pretty flat for new records highs from the S&P and NASDAQ yesterday, as we know. In here, the inflation day, which Mark was feverishly anticipated, was inadvertently published 30 minutes early, raising new question. Oh, I didn't know that. Did we know that? I didn't know. Did that happen? I didn't know that happened. That surprises me. Did it jump on that? Did it move early? There's the official release. So it would have been an hour. There's the official release, right? 1:30. I didn't really move 30 minutes earlier. Well, there's a little move there in the bar before. Well, that's interesting. I didn't know that. I mean, I don't know where that was released, if that was released. Let's see what it says. That's new to me. Fed messing inflation reading, however, hasn't changed the tone of comments from the Fed speakers. Kashkari is more of a hawk, though. Repeat, the Fed will have to keep interest rates at current levels for a while longer. It was released early, but wasn't noticed by investors per Bloomberg. Oh, okay, that's interesting. Thanks, Rufus. So yeah, how they missed that? Gosh, yeah, there was a gift there if you saw that. And then obviously saying, yeah, look, the people that we've got coming today, we've already mentioned all of those: Barkin, Harker, Mester, Bostic speaking today. Meme stocks, it's not really impacting us, but they slumped back lower in here after spiking higher more recently. The growing unpredictability of government bond markets called old school fixed income managed to retool their trading strategies. Again, doesn't really pick us. And talk about the economic data that we've already run through in there, and also mentioning Walmart. Walmart obviously already out in here. Already. So US inflation data. So yeah, there it is here. I haven't read this one yet. Was released 30 minutes early. Full investigation underway. Bureau 6 says early publication appeared to go unnoticed by investors. That's unbelievable. God, what an opportunity. God, it's that data, if you've seen that, massive opportunity, right? If you've believed it, though, maybe you wouldn't have believed it if you saw it. New highs hold. And so, yeah, futures markets sitting up at those new highs that we've made. Disinflation, US cooling, all these are the same. Investors reach for riskier assets. So risk on, we're fully in risk on mode. Traders, investors willing to take more risk, that's getting to equities. These are all the same. Wall Street boasts record closes. Inflation data fuels rate cut bets. We'll come to the rate cut bets. Stocks hold gains overnight on the futures. Jobs report doesn't really matter. Fed speakers in focus. That's the one we're really going to concentrate on today. Stocks and bonds bask in rate cut hopes. And finally in here, futures head higher overnight as softer inflation. Reports lift rate cut hopes. So lots of headlines, all pretty much the same. Up record highs, holding those records. Let's run through these. I was looking at these earlier on. So we've got the June meeting on the 12th of June, just under a month away in here. And still not expecting a rate cut in June. So that's unchanged. And then if we go to the July, very little chance, but actually a greater chance. Still now nearly a third, a chance, over 30%, 33%, 32% basically, chance that we might get a rate cut in July. Morgan Stanley, as we said, now we're looking at only a 28% chance that we're not getting a rate cut in September. So first rate cut now, looking for September, only a 28% chance will be unchanged in September. And if we look here, going into November, 16% chance. So not looking for any deeper cuts. So maybe on pause for November. No doubt that's, commentators are thinking that they're not going to cut rates right around the election. Now, does anyone know the date of the election? As you guys in the US might know. Election. I should have put the word date in there. It would have helped, right? Tuesday the 5th. Okay, so they could do it because it's after the election, right? So it's after the election. I mean, sometimes they try to avoid making a rate move right around the election. I mean, they shouldn't. Should just do stated course of what they do, but they try to be non-political. But it is after the election, so that's interesting. But what we're really trying to price in at the moment, it looks like the market's pricing in first rate cut in September, and then probably pause in November, and then another one by year end in here. So now we've got a chance now, only was that 27, 28, 30, 34% chance that we've only down by one rate cut or 27% chance by one cut, but then we got 34% chance that so it's 66% chance in here that we have 2 rate cuts by the end of the year. But very unlikely though that we've got 3 rate cuts. This is 3 rate cuts in here. Not much chance of that in here at the moment. And if we just go, so if you click on this historical tab, if you go and use this, I don't know if you guys really do look at this that much, but there's also the historical tab, which I don't really go and look to, but it shows you as the price moves. So I've opened up a few of these already. So this is the historical tab. You click on that historical tab, brings this up. You can pick still which date you're looking at, and then you can, I've blocked out some of these, so you can choose which rate profile you're looking at. So what I'm looking in here is for the July meeting. How much chance have we got at the July meeting? Well, it's kind of slightly picked up. This is for a rate cut, but obviously the most of the betting in here is on us being unchanged, so it's pretty sure, but look, a little bit of a fading chance that it's going to be unchanged. That's for unchanged, 525 to 550. Okay, so that's just dipped a little bit, obviously, and a little bit of hopes in here. It's picking up in here, hopes that we could get a rate cut again now by July. So there is an outside chance of a rate cut by July. On my next tab in here, I've chosen September. This is where the bets are all going for the first rate cut, and you can see now this is for the one rate cut. One rate cut now, we're sitting up at way over 50% in here that we're going to get a rate cut by by then. And then if we look at in here by year end, okay, by the December meeting, these are the 475 in orange to 500, 500, 525. So these have actually tailed off a little bit. I'm sure these have updated here, Wednesday. So yeah, they've actually tailed off that we're going to get this one in here, particularly 2 rate cuts in here. This is slightly picked up. For 2 rate cuts, it's slightly picked up. But if we go for in here 500, 525 for only 1 rate cut, it's tailed off. So the market now pretty assured. It's picking up slightly. We're going to get 2 rate cuts. Chances of 3 rate cuts though, even though it's picked up in here. This is for 3 rate cuts by year end. You can see it's still very low, about around, as we said, 25% chance of that. Just a quick nod through to the overnights in here. Obviously, Asian stocks playing catch up with their US counterparts. Up just either side of on the Nikkei and the Hang Seng of 1.5% on the overnights in here. European stocks actually dipping back lower. They followed US stocks higher yesterday and now actually dipped a little bit in here overnight, where US stocks having added on, the Nasdaq added on 1.4%. S&P was not dissimilar. We're up very slightly in here this morning, about a tenth across the board, but hanging on to those gains, which is really positive. The other big thing we've been shouting about is the bond yields in here, and bond yields plunge lower. That's higher prices, lower bond yields, and we took out this impulsive level in here back from, I think this is the employment report. No, I think this is, sorry, not the employment. I think this is the last CPI report. So bond yields went up. This is the last CPI report. So we've undone the negativity in bonds. This is the 10-year that was since the last. So basically, we went higher in yield and back lower in yield, and this is back to where we were. We're pretty much back where we were before the last inflation report. So, undone all of that higher yield activity. And we've got some important levels in here as well coming up on the yield chart, and then also on on the bond charts in here from my reports. If you go and take a look at these, I think that's really important here. Look, you've had this reversal of this big trend on the 10-year note. 30-year is nudging it right now. 5-year way through as well. 2-year was way through a long time ago. So the 5-year and the 10-year, and most importantly the 10-year, not only taking out this downtrend line, it's been hovering around that downtrend line. It also took out retracement levels and also now up at this swing level in here. All of this pointing to further upside in here. And remember, higher prices equals lower yields. Lower yields positive for stock indices, particularly the growth stocks, which means particularly for the Nasdaq. And stock indices obviously pushing back higher in here, making new highs, going up to the highs and making new highs in here. And if we go to the current market on the ES, you can see new highs being made yesterday above the highs back here from early April, and then the same on the Nasdaq. And if we go to the intradays on these, so we're just nudging above the highs there this morning. And on the intradays, there's the CPI data, there's the dip and the rebound after the cash index, and then it was up, 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 and then this is where the market closes, and then we grind higher. So this is a high level, super high level consolidation, considering the move that we had yesterday, considering the impulse move, then the follow through move in here, bullish right into the close, closes on the highs, and then manages to hold, not only hold on to the gains, hardly dip at all, not only hold on to the gains, but then get further gains. And the same story with the ES as well. Spike, dip, grind higher, right, rally hard, and then grind higher right into the close, and then grinding higher overnight and staying positive overnight. So all of this, I mean, I can't be anything other than bullish. This looks like it could go again in here as we're hitting new highs. You know, individual stocks in new highs. Those magnificent seven looking strong as well. So I think we've got a real risk of the market goes a bit off to the races today, and I think we could see another 1.5% update today. All right, that's my prognosis anyway. I'm going to leave you with that. I'm going to wish you all a great trading day. Great trading day. Take care, stay safe, and I'll be back with you with the final bull versus bear webinar of the week tomorrow on TGI Friday.